Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to the Build Wealth Canada show. Having your investments pay you large dividends or yield sounds great. It's truly passive income where money just shows up in your account without you having to do anything and without you having to sell off any of your investments, even when markets are down. But what if you get too focused on maximizing dividends or yield in your portfolio? After all, there is no free lunch when it comes to investing. There are always trade-offs. And it turns out that there are some pretty significant disadvantages for investors that just try to maximize their yield or dividends at all costs. And it can result in you actually getting a substantially lower total return over time on your investments. To help us learn what pitfalls to look out for when deciding on your investments, particularly when it comes to some of these very high-yielding ETFs that you may be seeing recommended online, we have Chris Heakes. Chris has over 14 years of experience in the investment industry. He's a CFA, has a Master's of Finance from U of T, and is a Director and Portfolio Manager at BMO Global Asset Management. Chris is going to take us through what we should look out for so that we don't fall for the yield trap. We'll also cover hidden fees that you may be unknowingly paying on some ETFs, along with some arguably deceptive advertising to look out for that you may have seen here in Canada when it comes to your investments. Lots to learn in this interview with Chris, so let's jump right in. All right, Chris, welcome to the show.
Thanks, Cornell. Great to be here.
Chris, one issue that's really started to negatively impact many Canadian investors is this trend to hunt for the highest possible yield on our investments, which can actually end up hurting the total return that we get on those investments long term. Can you start by first defining what we mean by yield versus the total return on our investments, and how do some investors fall into this trap?
Yeah, absolutely. Yield of an ETF was really, on its simplest form from the client perspective, is the ETF is going to declare a distribution, could be monthly, could be quarterly, even annually, but that'll be a certain number of cents per share. And typically, since we're talking about income ETFs today, typically you'll see monthly distributions. And so the yield you'll typically see in your systems, it'll take what's the most recent monthly distribution, and it would multiply it times 12. And that's your total kind of, call it forecast income for the year. It'll take that, divide it by the price. On a very basic level, that's a yield. I would say there's different provider approaches to how you decide what level of yield to distribute. You know, at BMO, we try to have a very robust generation of that yield. So we pay out what we earn. We're going to talk about covered call strategies, equity-based strategies primarily. You'll have a component of yield being generated from dividend yield. That's probably the most common form of yield in equity investing, certainly. Dividend yield. And then from option overlays, you can generate extra yield from the option, selling call options. We can talk more about that. And that's going to give you a total yield. And then you would deduct the fees of the ETF. In our case, 65 basis points on covered call ETF. So you would do dividend yield plus your option yield minus 65. That's what we're going to pay. But I think the important thing is that's not necessarily a rule that all ETFs have to pay that in that same philosophy. The yield number could be chosen, and here's where it gets a little tricky, and we're going to talk about it today, but could be chosen to make that product look more attractive. If clients are enticed by higher yields, and I think it's a natural thing as an investor to be enticed by a higher yield, a provider could just set the distribution rate almost wherever they like in some sense. There's no requirement that they're generating that yield. The yield could be set really high, and let's say you could create a product with a 15% yield. Now, are you generating that 15% yield? That's another story. So I think the important thing to look at along with yield is the total return. Because when an ETF makes a distribution of yield that's returning a source of return to investors, that's going to drop the price of the ETF. Just the same way when a company makes a dividend payment. Let's say Bank of Montreal is trading $130 and it makes a $1 dividend payment. All things being equal, the price of the stock will drop by $1 because that capital has been returned to shareholders. So ETFs do it the same way. when you're looking at yields and high yields being potentially, can be a trap, what that's going to do is the yield will come off the price. So how do you evaluate this more holistically and make sure you're getting what you want out of an ETF? Look at the total return of the ETF. And a total return at the simplest level is going to be price return plus the income return, or the component that was distributed through the yield payments, through the distribution payments. And I'll just say, let's use our example of an equity covered call yielding 15%, where I look at equities, typically your average return on equities is somewhere around 8% a year. Call that a historical return on equities. So if you're distributing 15, in most scenarios, you're probably over distributing. And what you'll tend to see is the price component of that return will be negative. So you have to look at the total return because, yes, the yield is certainly attractive at 15%, but if you have negative price return, if your yield's 15, but your price is down 20, you naturally have to ask yourself, is this actually what I want? Maybe for a RIF investor, it's okay to have a higher yield and depreciate price because they're drawing down on assets. But I think for a lot of investors, you really have to look at that yield, but also look at total return to really put the whole performance of the investment in perspective.
Is it similar to how some companies will continuing issuing dividends? They may issue more than they can actually sustain, because dividend being the distribution of the profits, just to make it look like, oh, everything is fine at our company, things are good. Look, we just issued a dividend, maybe we even increased it, things are rosy. But in reality, if you look at the financials, it's actually not sustainable and they can't sustain that long term. Maybe they're even taking on debt so they can issue that dividend. Because again, it's about this optics. And especially when interest rates were low, people were hunting for this high yield because you can get it on like a high interest savings account. And then so they buy into these stocks, and then now they bought into something that actually cannot sustain that long term. And so their total return might actually go down quite a bit because the value of that company drops. So it sounds, while a company may play these games to try to entice investors to put money into them, it sounds like on ETFs, we actually still have to be careful. Even though an ETF can have thousands of stocks within it, it sounds like we still have to be careful because the ETF provider can try to enhance that yield in a non-sustainable fashion in the same way that a company does. Is that a correct way of looking at it, or did I misinterpret?
I think it's a great way to look at it. And in both cases, it's not sustainable. When you look at that company and they're over distributing, meaning they're paying out more in dividends and they're generating on the cash flow side, it's not sustainable. Maybe they can keep it up for a certain amount of time, but eventually their bank account's not going to have that money to make the payment. You're not able to issue more debt or et cetera. So it's not a sustainable thing. And the same thing on an ETF. Think about maybe an ETF is yielding 15%, but if the price is going down year after year, your asset base is shrinking. So in a sense, you're going to run out of assets because you're over distributing every year. So again, I think what's the lesson for investors? Looking under the hood. And if you're looking at a dividend paying equity, and this is what we do in our dividend based ETFs, which is a bit of a side topic, but we look at what are the payout ratios. If a bank is making $100 and paying out $50 in a dividend, 50% payout ratio, that's pretty sustainable. If a company is making $100, but they're paying out $125 in a dividend, that's not sustainable. So you have to look under the hood. Just like in ETFs, you got to look under the hood, look at those total returns and figure out, are you actually getting the total returns you expect to be getting in the strategy? I think it's a great analogy.
That's great. And yeah, I'm so happy you wanted to talk about this today, because I feel like Canadians deserve a bit of a public service announcement when it comes to this, because when I personally even just go on YouTube, let's say, and the algorithm knows what I'm into, so it's suggesting all these videos on finance-related, investing-related subjects, so many of them, I cringe a little because so many of them are, look how much I got in dividends, look at this yield I'm getting. That's the headlines. That's what gets the clicks. That's what gets people interested, because, hey, you're only getting 8% on your equities. I'm yielding 15%. And so I do feel that is this trap that's easy to fall into. You said there's these companies that play these games. There's ETF providers that play these marketing games. But I've also noticed, unfortunately, with some content creators where they play these games as well, where they're trying to just get the clicks because then they get the ad revenue. And so it's all about dividends yield. But then the reality is that's not the whole picture. Like you were saying, there's the total return. That's what we actually care about. Who cares if you're getting 15% if your investments are dropping substantially year over year in terms of you're getting capital losses, but oh, hey, I'm getting 15%. Okay, what's your actual return on this? So it's forcing people to not really look at the whole picture, which bothers me because I really think investors should be making informed decision. If part of your strategy is to get higher yield and you feel you have good reason to do so, okay, but you can't just put these blinders on and focus on yield exclusively while your investments are dropping in value year over year and you think that things are going great, right? Because, hey, I'm getting 15.
100%. Very well said. I agree absolutely with that. Yeah.
Awesome. So I was listening to the interview that you did on ETF Market Insights on YouTube. I know you're a guest there. You're a frequent guest there. And there you mentioned certain warning signs that we should be on the lookout for when we're considering buying an ETF that appears to have a really attractive yield. Can you speak to what these warning signs are and how can we do our due diligence as DIY investors to make sure we're not buying an ETF that has a really attractive yield, but potentially a really low total return long term? You mentioned that 15%. It sounds like that's one of the flags, eh?
That's a warning sign to me. If it looks too good to be true, as we know in life, that might just be the case. And to take a step back, I think with equity-based covered calls, like I said, equities are returning 8%. And maybe you're investing in tech equities and they've got a bigger growth profile. Maybe tech is a 10% return potentially, right? And investors will have tech as a portion of their portfolio. But, we're somewhere around that 8% range. So if you see a really high number, that should raise a red flag. Now, covered call strategies can turn some capital price appreciation into yield. And essentially the way a covered call strategy works is it's going to exchange potential upside in return for current income. And it's a trade-off. And what I mean by that is you can get more yield, but what you get is less upside. Or you can try and find a sweet spot. Certainly at BMO, that's what we do. We only cover half the portfolio and we sell our options as far out of the money as we can to generate that yield. And so on the option side, we would target 3 to 5% in added yield. And then you would add that to the dividend yield, take off the fees, and that would be your expectation of the net distribution yield on the overall product. Typically, our covered calls are in the 6, 7, 8% range. And logically, I can say I feel that equity returns should support that level of distribution yield. Now, you're going to get a higher portion of your return through the income. But if equities return 6, 7, 8%, maybe a little bit more if we have that softer landing, but somewhere around that long-term average and it's sustainable. If you're at 15, think about that trade-off. If it's a covered call strategy, perhaps it's much more aggressive on those options. And let's say you're writing at the money options. And so what that means is BMO's trading at $130. At the money option means you give away the future return for anything over 130. Now you get more income for doing that because you're giving more away. But think about what is being given away. You're giving away all the upside in the case, right? So when you think about that trade-off, there's income versus growth. If it's high income, it's probably very low growth. And in fact, like we were saying, it could be negative growth. So if you have to deplete your capital over time, if you're making 8 and you're paying out 15, on average, your price has to be going down 7% a year to balance that very simple equation. So in fact, you can get income to 15%. We could do income at 20%, but it's just going to bleed away that asset base. And to your point on kind of, clickbait and that kind of thing, I agree completely. But the thing is, you have to care about your capital base just as much, if not more, than the yield you're generating. And that basically means caring about total return. When you're looking how to decipher it, that absolute level of yield, anything over 10, starts to be a bit of a warning flag in my mind. And then that should lead you to go look at the price return and say, okay, that's great, the 15% yield, but what's the actual price return doing? What's the total return doing? If you have the tools to compare an ETF, we actually offer tools on our website. You compare ETFs, not just ours, but any Canadian listed ETF. And you can go and see what's the total return experience. And if you see a total return of 5% and the yield is 15, keep that in your head that what that means is the price went down 10%. Unfortunately, it's a little more work, but I think the work is well rewarded because this is your capital and you want to make sure you understand. And I don't know if I'm jumping the gun, but the regulators, got some great regulators in Canada. They've been innovative in many ways in the ETF market, more so than the US, but also obviously the concern for customers is always there. And I think we actually have some of the best regulators in the world. And they came out and said to the companies, you can't advertise on yield anymore. You can't just have 15% in giant font and advertise on that basis alone. They said this is contrary to the Investment Act. So it was a warning, but a very well placed one. And so now what the regulator said, first of all, you can't make yield that prominent. And if you're going to include yield, you have to include performance as well, total return performance. So hopefully that will also help investors, because now when you see these things marketed at you, the provider will have to also disclose the total return. So make sure you read the disclosures as well. Might be it'll probably be in a little bit finer print, but make sure you also look at those disclosures. And so I think that's a couple kind of strategies that you can look at. And I think obviously like this conversation we're having, hopefully this is a great service announcement and helps people look a little bit deeper and get a better understanding of what's happening under the hood.
That's great. So it's nice to hear that the regulators in Canada have cracked down on these ETF providers and these somewhat questionable advertising practices. Unfortunately, on the content creator side, anybody can still post a YouTube video about, hey, I'm getting 15% yield.
Right.
I'm beating all you equity investor, all you asset allocation ETF, total market index investors. You guys are missing out. I'm getting 15 year over year. And yeah, so we still have to always be careful. I guess it's the whole kind of buyer beware thing. We still have to always be careful as DIY Canadian investors. But I'm glad at least the regulators have stepped in and put in those rules for the actual ETF providers. But yeah, for sure, us Canadians, and that's why I love episodes like this, is I really think it's the overwhelming majority of us, we're not educated on this at all in school. And so you pretty much have to seek it out yourself. And it's so easy to fall for these traps when you have not been educated in any sort of formal school setting. So I'm really glad that you mentioned that. And now a quick intermission to tell you about an additional free resource that you may find helpful. On this podcast, we often cover best practices that can not only help you now, but will also be relevant throughout your investment lifetime. But what if you also want an update on what is happening with your investments, the markets, and the economy right now? So to help me stay up to date on these topics, a great Canadian podcast that I listen to weekly is called Views from the Desk. They provide timely information for us Canadians on what is happening to our investments right now, as well as other key factors affecting us, like changes to our interest rates, our inflation, and regulatory changes that we should know about here in Canada. The podcast is hosted by BMO ETFs. I'm a huge fan of theirs. I own a lot of BMO ETFs myself, and it's a great resource for both new and existing ETF investors. I hope you check them out. All episodes are available for free in your favorite podcast player. Just search for Views from the Desk. One thing that I've noticed, flipping gears a bit, because we talked about people just focusing on yield exclusively, there's also another trap, which is the flip version of that. And that is, I think it's also very easy for some investors to only look at the price increase or price decrease of their investments and not factoring in the income that it generated, whether it's dividends or interest, depending on what you're invested in. And so this also, I think, speaks to your point about you always want to look at the total return, because I have noticed in quite a few, I would even say majority of sites, if you just Google like a ticker of a stock or of an ETF, they'll show you the chart and it'll show you the returns of that. But at least in my experience, a lot of times it's just showing you the price appreciation or depreciation. And it's not actually showing you the total return, which would include the dividends or interest that it also pays out. And so I think that is also a very important thing for Canadian, especially DIY investors, to be aware of, is you do want to look at that total return, not just from an income side, but from a capital gains, capital losses side as well. And so anytime you see a stock chart, anytime I see a stock chart or an ETF chart, I'm always asking myself, okay, great. Is this the total return, or is this just capital gains or capital losses? Because that's how you can actually compare apples to apples when you're viewing two different investments, because they may actually have the same return, but one has way more capital gains, the other one has way more yield, but then they actually even out when you look at the total return. So on your case, what when the investor wants to look for that information, what is the best? Are there any resources that you like to use within your organization? Are there any resources that you like to use yourself when you're evaluating investments to make sure that you are looking at that total return? I'll let you know what mine is in a sec, but I'm curious if there's any favorites you have.
Yeah, absolutely. Very fair point. And I think most do-it-yourself trading platforms, it's going to have the price you bought it at and the current price, and it'll say, oh, it's down or it's up. But you're right, doesn't tell the whole story. Fortunately, I'm spoiled as a professional with access to tools that I can make it very easy. For your average do-it-yourselfer, I would say the provider website. The ETF is over a year. We have to disclose performance on the website. So whether it's ours, whether it's others, you will see total return there. On our website, we got a couple tools. So we've got a chart that will build in the total return.
Nice.
And if it's an index ETF, it'll also show the return of the index as well as the ETF itself. So you can see a total return view. We have a comparison tool as well, like I mentioned earlier, where you can plug in any ETFs in Canada, ours and competitors, and get performance and total return, get a chart, get sector breakdowns, some other characteristics about the fund that might hopefully provide insight into the differences. So I would say that's bmoetfs.com would take you there. And so that would be my number one site, but
awesome.
Go ahead with yours
and on
as well.
On there, are you able to also look up other providers' ETFs? Let's say somebody wanted to look up a Vanguard ETF or an iShares ETF.
Yep.
Do you provide that there too?
There's a comparison tool, and so you should be able to locate it fairly easily from that website, bmoetfs.com. And you can put in,
fantastic.
I believe it's up to about 5 ETFs. So if you want to put in BMO versus iShares versus Vanguard, it'll do that for you. It'll show you the returns. It'll compare the fees. It'll compare the sector differences between the three, some other information to total returns, of course, to help you make that investment decision.
That's fantastic. That's great.
Yeah.
I'm gonna have to give that one a shot, and I will link out to it as well in the show notes. So for anybody listening, if you go to buildwealthcanada.ca, you'll see all the episodes listed, all the recent episodes listed. So you'll see the one with us now, and I'll make sure in there I have the link to those ones as well in case you prefer it that way. But that's great. Yeah, because in the past, I've used Morningstar Canada to look up the ETFs to get a total return, just because I used to work at 5i Research and Canadian Money Saver magazine, and they have a whole team of analysts. And when I asked them, like, hey, what do you guys get for total? What do you use for total return? That was what they use. And so I just become accustomed to using Morningstar Canada. But sometimes like it's down or it's being slow or that kind of a thing. So I'm really that's awesome that you guys have a tool. And there's a lot of advertisements and stuff there too. So we need to try yours out as well to get those numbers. And it's great that you have other ETFs there too, not just your own. So that's fantastic.
Yeah.
All right, great. I'm excited to try it out. I'll give it a shot after our call.
Awesome.
And I'll be sure to look onto it. That's great. Okay, that's great. Now, one type that we talked about this a little bit, one type of ETF that's recently fallen under scrutiny and got the attention of the regulators here in Canada are some of these covered call ETFs out there. There's been some potential, like we said, potentially misleading advertising, proclaiming extremely high yields without sufficient mention of that potential downsides of some of these ETFs. We already covered this a bit, but just in case you have anything to add, can you speak to this issue a bit and how can we best protect ourselves? I know we've pretty much covered it, but I just want to give you a chance in case there's anything else that you think we should be looking at to protect ourselves.
One other thing that's been interesting in the industry is this concept of light leverage. So what this is, under the liquid alt framework, I'm going to go a little bit into the weeds, but the regulators introduced a liquid alternative framework about 4 years ago. And what that allowed to do is gave providers the ability to offer products that had a little more leverage. In some cases, it could be up to 3 times leverage, but it gave providers some more flexibility to provide solutions to the end client that are approved solutions for the end client. And the whole idea was alternatives can offer a portfolio diversification benefits. Either they could increase your return, they could reduce your risk. Overall, to give retail investors the ability to make a better portfolio. Typically, alternatives, you would have to be a very high net worth accredited investor, or you'd have to do offering memorandums and like a lot of paperwork to get into these. They offered these liquid alts to make it more accessible, which again, I think was a very good initiative by the regulators. So circling back, One product that came out of this was products that use 25% leverage. And so it's called light leverage because instead of, you put $100 in, but what they do is they borrow against that $100, they borrow an extra $25, and then you invest $125. And I'm not here to say leverage is good or bad. It is both. It's good when times are good, and it's bad when times are bad. And we can talk more about that. I don't think it's ideal in a cover call context, but I don't want to make this answer too long, but I don't think it's ideal in a cover call context. But one thing that we've seen in the industry is, so 25% leverage, let's say a cover call's yielding 8%, and you apply 25% leverage. That would take the 8 to 10, right? Because 25% of the 8 is 2, and so now you get an extra 2. Now you're at 10. And the one thing you'll see on providers' websites, they'll say, okay, you're getting 10% yield now. Now, again, is that telling you the full story? No, it's not. Because when you borrow cash, unfortunately, are we borrowing cash at 0% interest rates right now? No, of course we're not. The Bank of Canada overnight rate is somewhere around 5%, or it's at 5%. When you're borrowing cash as an investment fund, probably, let's call it 6. So you're not borrowing at 0 to get 8. You're borrowing at 6 to get 8. So therefore, your yield is not truly going from 8 to 10. It's actually going 8 to 8 and change. So that's, again, it's technical details, but there are tools, and we could talk maybe a little bit more about fees. There's certainly things to watch out for on the fee side that can also detect some of this noise that you'll see as well. But that was just one that came to mind. I think beyond that, like we talked about, look at the total returns. Obviously, a high yield above 10%, I think should trigger that second level of review to say, okay, yield's great, but am I getting performance as well on the back end? Are you taking care of my capital, or is my capital being eroded? And I think more times than not, at that level, you'll see a negative price appreciation in most cases. So that's a couple, extra dynamics on the fee side that happy to get into that.
Sounds good. Yeah. Before we move on, though, you mentioned the covered call ETFs that you guys have. I know you guys do not do any sort of these shady practices when it comes to advertising on your ETFs. Maybe did you want to mention some of the ones that you do have that are within the context of this conversation? Any particular tickers that you think, for listeners that want to maybe follow along or look into them?
For sure.
Can you provide some of those for us now, maybe?
Yeah, for sure. So we launched the first covered call ETF in Canada. We're the largest provider of covered call ETFs. And the first one we launched, which coincided with when I joined the ETF team in 2011, was the BMO covered call Canadian Banks ETF. This has been a topical one. You were talking about yield investing. Banks themselves, forget about covered calls, are yielding around 4.7, 4.8%. When it historically, that's a pretty good level for the banks. The historical average is about 4%. Banks have been also amazing dividend growers over time. I believe the last time a Big Five bank cut a dividend was in World War II, perhaps. We're talking 80 plus years. So they keep the dividend, they increase the dividend over time. Great dividend growth stories. So that's one that's been very popular, and it's been topical. Banks were somewhat depressed the last couple of years, and we started to see, as economic shift has turned a little more positive, certainly in the last, call it 4 or 5 months. Banks have benefited from that, and that remains and continues to be a very popular one with our investors. Very simple, but it's been a very good exposure over time. I also do a lot of work on the high dividend covered call suite. And so we've got a high dividend strategy in Canada, US, and internationally. So there's ZWC is the Canadian one, for example. We've got ZWH in the US. ZWE is actually on Morningstar. It's a 5-star fund, so that's always nice. And Morningstar actually compares funds and ETFs. If you look, it will aggregate them into the same competitive bucket, which I think is interesting as well. But so the high dividend series, and again, a lot of what we're saying on the ETF side with respect to covered calls, it holds, like you said, it holds so true with the individual companies. And let's say you're a dividend investor in stocks. What should you look for in stocks? Don't look for the high yield. Don't look for the highest yielders, because that usually means they're over distributing. A dividend cut is likely coming, and investors hate dividend cuts. So typically, if you look at historical returns, those top dividend payers actually aren't the ones you necessarily want. You want the solid dividend payers, but ones that are growing their dividend and paying it sustainably. So that's what we focus on in our dividend strategies. Just think this is what, when investors think about dividends, typically it's a blue chip, solid dividend, little more mature business model, sustainable cash flows, sustainable dividend levels. So that's another one as well that's interesting. And maybe lastly, I'll just mention one more. And sorry if I've taken too long, but ZWT is one we launched 3 years ago, and we've got quite a few sector ETFs. This one is based on technology, and it's 30 technology names. And technology doesn't really pay a dividend. Half of the companies don't even pay any dividend whatsoever. But with the cover call overlay, you can generate some yield out of those investments. And actually doing it in foreign markets is actually a very tax efficient way to generate yield. So that's another thing. When you're investing in dividend paying companies outside of Canada, there's going to be a withholding tax, and then it's going to go on your foreign income. So it'd be income treatment. When you're doing cover calls, there's no withholding tax, and it goes on your cap gain portion. So it's actually pretty tax efficient as well, which is another nice little side benefit about some of those. But that's another great one. And there's quite a few sectors that we've built out over the years. But ZWT, certainly a sterling performer. And if you need a little bit of tech in your portfolio, just to have that there, because I think we all need some techs, but that's a great tool to control that exposure.
For investors like myself, just to give some context, I'm a pure passive total market index ETF investor, just index investing all the way. For somebody and I know there's many listeners of the show that also invest in that same way, where they'll buy like an asset allocation ETF, or they'll buy the underlying ETFs that make up an asset allocation ETF, and they just keep it simple that way. That's what I do, at least.
Those are fantastic ETFs, by the way. Like Total World Market, I believe ours are 20 basis points. They're either 18 or 20, but I'll say for the sake of conservative, at the 20 basis point management fee to get exposure to everything at such a reasonable cost, I think is such a fantastic product. Sorry, I just wanted to jump in and I'd say that's a great way. I was
curious about your thoughts on that type of investing as well, because these other ETFs that you're mentioning, for someone that's not in the industry, they do sound more complex. There's more kind of moving parts as well, more to understand about them. Versus the passive index investing approach is fairly straightforward, right? You can even just buy one asset allocation ETF. Like for my kids, our ESP, I basically buy your ETF, ZEQT, which is the all equity, because my kids are still pretty young, so I just go all equity. So I just buy yours, ZEQT, and easy. I'm done for the year, right? I just top it up every year when the contribution room goes up, and then that's it. For investors like myself who like the simplicity of it, who like that approach, where do these more, I'm not sure what the right word is, advanced, more nuanced products, how do they fit in? At what point should an investor like myself and other passive total market index ETF investors, at what point should we consider these for our portfolio? Do we even need to consider them? What role do they play, would you say? Because I can see it being like information overload, right? Like I'm happy with my asset allocation ETF, and then here's these other products that look pretty attractive as well. How do we decide?
First of all, I think this is a very big question, but we'll try and answer. I'll give you my thoughts, and this is a huge question, but in my opinion, perfectly fine for looking at it the way that you do. And my kids they're in the middle age, but I do exactly what you do for a big chunk of it, at least. I have gone to the Z Grow ETF, which is 80% equity, 20% fixed income. And I probably need to think about maybe even going down one more risk level in the not too distant future, because they're 12, and turning 12 is not super far away from university age. And
as much as us parents like to deny it, right? Oh, they're still kids. And then before you know it, it's, you're going to be 16 soon. You'll be driving. And
time flies. And it's one of these kind of great perceptual things to overcome is even a kid, like a newborn, like a 1-year-old, would have probably a shorter time horizon to university than your average 65-year-old. Because your average 65-year-old, if you make it to 65, I believe the stats are you're going to be living somewhere around like 85, maybe a bit more. So you got 20 plus years. The kid's got 17. So that's one of the great interesting things I always thought about. And certainly a 12-year-old, we're talking 6 years. Scary. But anyways, that's a separate conversation. Listen, and one other thing that always comes to my mind is Warren Buffett said, like, asked the question, how should people invest? Well, he's got his approach, and he believes in it. He can uncover value, identifying we know the Buffett, very financially sound companies with competitive advantages that's going to perpetuate, and that can lead to him outperforming. But he said, if you're out there buying SPY, which is the US S&P 500, or in Canada, you can buy our ZSP just for US market exposure. He said, you're already doing great. So that's one thing. I think where you look at different strategies is maybe a twofold lens is how I would think about it. Perhaps you're trying to improve on risk-adjusted performance versus the benchmark, and there are a lot of investors who try to improve. There's different ways to do that. I would say very broadly, there's factor-based investing, so where you take a strategy like dividends or low volatility, and again, this is such a big question, but they can offer that ability to outperform over time or improve the risk-adjusted return, which is return divided by risk. So that's one. Or perhaps some investors do enjoy and want to express tactical views on sector ETFs, and things can provide that. I think the one I'm a little more interested in is maybe advisors or clients, advisors, institutions, whatever the case may be, investors trying to solve a need that's specific to them. And so maybe I'll just step a little bit away and just talk about low volatility ETFs because they're very popular. And so when clients, let's say later in retirement, nearing retirement, in retirement, perhaps let's say 65-year-old, who have perhaps built a nest egg and still have that ability or perhaps need to stay invested in equities, but they want to lower the risk profile of those equities. So broad betas have a certain risk level. Even in the US, if you look at under the hood, there's a lot of technology companies in the broad beta. And some technologies is almost 30% of the index. But they also move some technologies to other sectors. So if you go back and say how they define technology maybe 5 years ago, technology would actually be 45%. And technology is always going to be growth, and it's been a very good theme, but it's also going to present risk. And so investors perhaps in that segment may want to manage their risk a little more acutely and say, I'll give up on some of the big upside returns of the market in return for having much better capital preservation should markets go down. Because the last thing you want to see happen to a nest egg is have a major market event, which do unfortunately happen from time to time. Where a different solution could fulfill a client need, I think that's where you could say broad beta. It's an excellent way to do it. It really is an excellent way to do it. Diversified, low cost, 100%. And it's a great way to do it. But if you have specific needs and you want to tailor a portfolio on a risk level or on an income level, I think that's where there's lots and probably to your point, too many choices, but there's different ways to peel the onion, so to speak. And I think that's where investors may look at some of these products to say, can it solve a specific need for me more efficiently? So that's my awesome. 3-minute answer of trying to explain or trying to put together how to approach, index versus active or more active based approaches. But yeah.
Yeah, thank you for that. I realize it's a bit of a loaded question, but I think it's critical because there's literally thousands of ETFs available out there. And I do worry about some investors where it's very easy with that number of quantity and all those options to get into the state of paralysis analysis, particularly for someone that's maybe completely new to it and aren't really set on a particular investing type yet, and they're maybe learning this for the first time. I think it can easily become a thing where we just keep pushing off this on the back burner. I'll get to it later, because it's so overwhelming. There's so many possible options out there. What do I choose? And so they just end up sitting on it they've got these high interest savings accounts with hundreds of thousands of dollars in there, or they're just like, I'll just do GICs for now until I figure this out. And then meanwhile, that's getting eroded by inflation and all that. I don't. So it's interesting, I think, to think about, okay, at what point do you want to venture into this other world of these more advanced or more kind of customized products? Do you think it'd be fair to say that maybe for someone that is completely new to it, maybe is teetering on information or choice overload at the moment, that something like an asset allocation ETF is an excellent starting point to just get your money invested, get in there. Now you're saving for your RSP, your TFSA, your kids' RESP. You've got the ball rolling, you're investing. You're not just sitting on a bunch of cash or spending it all because you haven't gone to that project yet of figuring out what to invest in. And then once you've got that under your belt, phase 2 could be, okay, do I want to venture into this other world now of maybe fine-tuning my portfolio a bit with these products that you're mentioning so that it's a little bit more custom for my individual situation? And then at that point, the answer might be, yes, I want to go down that path, or maybe, no, I actually like just doing like an asset allocation ETF. I'll just keep buying ZEQT and be done for the day. And that's okay. You don't have to go into this thing, but it's out there if you do want to fine tune your portfolio. Do you think that's a good enough mental sort of process to go through, particularly for investors that are new, but I guess also investors like myself who have been doing this for a while? And there is always this temptation of, hey, maybe you should fine tune a bit with these products, but you don't have to. What are your thoughts on that? I'm just trying to get some like concrete, practical action steps for people who maybe are struggling with this a little bit from an information choice overload perspective.
Yeah, I think it's a great way to approach it. If you're an individual investor, if you're an advisor, if you're an institution like BMO Asset Management, the phrase that comes to mind is core satellite. Well, that's what we talk a lot about in the industry.
Right.
And I don't know if that resonates with everyone, but what does core satellite mean? The core of your portfolio, I think it's natural and very, to me, justifiable to be your broad market cap index, fixed income, everything. So that is your asset allocation ETFs in a nutshell. So that's your core of the portfolio. And then what the satellite means is you put extra things around the edges to tilt the portfolio in the direction you might want to take it. And maybe that's more income. Maybe it's less risk. Maybe you want to make some tactical calls on sectors, and that's your prerogative as well. And I think a lot of investors look at it that way. And I'm including like institutional investors. Start with the core, and then how are we going to deviate around the core to best maximize what we can do? So great place to start is the core, and then look to build around the edge. And it's gonna have one big consequence is that you will learn more as well. And I think it will deepen your insight around building portfolios and what works. Certainly we try to provide as much educational material as we can on the website and some of these like ETF comparison tools and see how things would have performed from that perspective to help make insightful choices. But I think that's a great way to do it. And you can leg into it from a core satellite. And as you become more comfortable, the satellite can become a little bit bigger. But I think that overall, that's a great way to look at it.
I love that. Yeah, because I think an easy trap mentally to fall into, at least for myself, it's okay, are we going to go, I'm either a purist index investor or I'm an active investor. It's just that or the other. But really, I love what you're saying, how it's not that. You can actually, you have that core. So you're not all of a sudden selling all your asset allocation ETFs and only buying covered call options or something. You're not proclaiming to do that. You're saying, let's actually keep your core, but if you do want to fine tune, maybe you trim some of that money from that core and put that into these, like you said, satellite positions, where now it's a little bit more custom tailored to what you're looking for. So it's this gradual incremental thing as opposed to this giant sweep where, oh, I've been an index investor for 20 years and now I'm just going to quit that and be this active investor where I'm placing sector bets and using leveraged ETFs and covered calls and all these other things.
Right.
I think that's such a much more manageable way. I love that framework. And then it becomes a lot less overwhelming because if you don't find a good fit for these other investments, then there's nothing wrong with just sticking with your asset allocation ETF. Maybe that is the best fit for you. But these other options are out there in case you do want to fine tune and get that extra little whatever it is you're looking for out of your portfolio. That's fantastic. I love that framework. Fantastic. Thank you, Chris.
Yeah,
excellent.
100%. Yeah, for sure.
Very practical. And now a quick message from one of our sponsors. Do you know why asset allocation ETFs have become so popular? Asset allocation explains over 90% of the variation in a portfolio's quarterly return. So it's no wonder Canadian investors are turning to these ETFs. Today's sponsor, BMO ETFs, offers these innovative all-in-one solutions with the BMO All Equity ETF, ZEQT, the BMO Growth ETF, ZGRO, the BMO Balanced ETF, ZBAL, and the BMO Conservative ETF, ZCON, and many more. BMO developed these to help provide investors with ETFs that offer broad diversification and are also low cost and simple to use. These ETFs invest in a number of underlying index-based ETFs and are rebalanced automatically back to your set asset allocation or mix of stocks and bonds. They offer a hands-free approach to investing that is built on disciplined weights to provide exposure to different geographies and sectors all in one solution. BMO actually offers 8 asset allocation ETFs, and you can learn more at bmoetfs.com. And now back to the show. So another potential trap that I noticed with some ETF providers is that they'll advertise a 0% management fee on their ETFs, but then there are some hidden fees on the back end. For example, charging the investor fees on the underlying ETFs. And then you mentioned leverage as well, like how, okay, if you're using leverage, that money is not free, they're borrowing money, so that's an extra fee as well. So when it comes to those kinds of fees, what should we be looking out for? And if we just look at the MER, which is like our go-to fee number, is that good enough? Does the MER include all these other things or not really? Do we actually have to look under the hood even more?
Yeah, it's not always giving you the full picture. And you nailed it in terms of breaking it down. I'm not even going to throw in another one, but you're right. It's what's the price of the ETF? And they might say it's a 0% price, a zero fee product. But you're right. A lot of ETFs, for various reasons, will hold other ETFs underneath them. In mutual fund, we'd call that a fund of fund. In ETF world, we can call that an ETF of ETFs, if you will. But those ETFs will have fees as well. And there could be fees associated with those. If there's a cost of leverage, that is another added fee. Another piece of data is the TER, which is the trading expense ratio. So when trading equities, options, different assets, there can be a cost. So that's another thing you can add to. So if you want the total cost of ownership, you got to open up all these things, or you got to add up all these things. And so the challenge for investors is, well, I went to the website and it said 0. And it's, this might be something the regulator has to look at as well, because if it's not 0. And so it makes it difficult for investors to assess the overall cost of ownership. So my recommendation is there's a new document, relatively new, came out in the last few years, called ETF Facts. And we display it pretty prominently on our product pages. So if you go to our website, you would type in your ticker, ZSP, S&P 500. You should see 2 red bubbles near the top. One's going to be a fund profile, just general information, performance, general information type stuff. And one will be the fund packs. And that's a regulatory document. And the regulator has spelled out there has to be specific things, one of which is the total cost of ownership. Again, this is something that every ETF provider has to display on their website. I realize it's a little bit of work to go to individual websites and pull up this document, but unfortunately, this might be the only way you can get the true fee picture, which is very important. Fees are a very important thing to consider in the context of an investment. And just to give you a sense of how much it can swing, I've seen swings of over 2%. So let's say the fee on the website was 0.5. You go and look at the total cost, it was 2.5. I've seen swings that big.
Wow. So
it is a very important issue to understand. In our case, I could say confidently, BMO, if it says 0.65% management fee, there'll be tax on top of that, 13% for our friends there. So that'll take the 65 to 74, but that'll be it. And then there would be a trading cost as well. But our trading costs, we do try to minimize those as much as possible. But yeah, really, that's the way to get to the answers. You got to dig that up. So the ETF Facts is a great document. You'll see that total cost. And again, if you're investing in equities, think about, again, go back to that, it's 8% on average. If you're paying 2% in fees, that's a lot, right? That's a quarter of your return. And that will obviously have compounding impacts over time. So managing costs as I'm sure you are very aware, as a broad market and some of the lowest cost tools that are available to clients, like asset allocation ETFs, ZEQT, and index ETFs. But costs are very important. So that's something investors should not overlook. And ETF Facts is a great place to look for information on that.
That's great. And I assume that these extra hidden fees, would it be fair to say that they tend to be more prominent in some of these more complex products that we already spoke about, in particular the ones that are using this leverage? They're trying to show that, oh, look how we're getting 15% yield, things of that nature. Is it those kinds of products that we spoke about earlier that tend to have these extra things on the back end? Because I imagine with something like a total market index ETF, we mentioned ZEQT, for example, that I invest in, like something like that, I imagine would not have these types of extra things, whereas some of these more complex ones do. Is that fair to say?
I think in general, that's a fair statement. The more complex a product, you tend to see the fees go up. In some cases, I can make the argument that you get value for your fees. And I'd say for the cover calls, overall, our cover calls, I would make the argument for an income investor, you can get value for the increased fees. But, always that's going to be a trade-off between, okay, what's your actual end fee and how much added value are you getting? And for me, if it's going over 2% on an equity framework, that's a lot. And so that's just something I think to definitely watch out for. So yeah, totally. I think it does correlate with complexity. I think that's a natural feature, for lack of a better word, of the market, of the industry. Before we draw any total conclusions of, am I getting rewarded for the fee? Let's find out, what's the actual fee first? Is it what's on the website, or what's the actual fee? So then that's your starting point to say, am I getting value? And yeah, you can tell with my opinion, if it's over 2%, I think it's going to be tough to justify that kind of fee on a rules-based ETF in general.
And Chris, over the years, I've noticed there are different schools of thought when it comes to how our investment portfolios should look while we are in the accumulation stage during our working years versus the decumulation stage when we are financially independent and living off our investments. Some will argue that you need to shift to more income-producing investments in retirement, such as focusing more on things like blue-chip dividend stocks or covered call ETFs. Others will argue that you should continue to stick to investments like total market index ETFs, where you're just buying the market as a whole through something like an asset allocation ETF. Can you give us your thoughts on this debate?
Yeah, I think there's a couple interesting things. I like thinking about an accumulating investor versus a decumulating investor versus someone in retirement, not in retirement. Because those two things, while they generally line up, they don't always line up. And what I mean by that is we could have someone in retirement, 65-year-old, maybe it's just retired, maybe with a very well-rounded portfolio, and they may have extra. They may be thinking, obviously, I have to take care of myself and maybe my spouse, and then obviously in the meantime, but a certain amount of the portfolio may be going to my children. And in that situation, you would say a portion of his portfolio would be, you would think of it from a decumulation standpoint, but a portion you might be thinking from an accumulation standpoint. By the same token, you could have a younger investor who has major expenses coming up, right? So they're going to make a down payment on a house, they're buying a car, things like that. Obviously now that changes their time horizon. So it's not, I don't know, it's difficult to do a broad strokes, but I do thinking about the way you framed it in terms of accumulation versus decumulation. And the obvious answer with one component of the answer is when you're accumulating, you have more risk tolerance. Typically, you're going to have a higher equity allocation. Perhaps you could have a little higher weight to things like technology. NASDAQ has shown higher returns over time. It also comes with higher risk. But if you have time on your side, you're an accumulating investor, you perhaps have that tolerance. The part where I think we want to be really careful, you have to be careful in both cases, but the decumulation I think is where I think you want to be really careful because if you're decumulating, you've accumulated already. Now you're shifting gears, you're going into decumulation. there's more at stake. Your portfolio is probably at its peak kind of thing, and you're sensitive to risk. And what I mean by that is if we have, and I'm not trying to stoke fear, these market environments like 2008, they happen every 10 years or so, right? 2001, 2008. COVID was a very quick, intermittent sell down, but still, obviously a significant sell down. That can really jeopardize return streams because now you're decumulating. If there's a major market sell-off event, you don't have time to make it back. So yes, you want to shift obviously to less risky. You still may need some equity, need some growth exposure, but you can shift to less equity. Here, I think in the decumulation, perhaps you can look at some potentially alternative strategies. Like I mentioned, low volatility. And I don't think we got time to go into it all right now, but on the fixed income side, you might, looking maybe shifting a little bit more shorter in duration, but depends on your profile. Duration is both a good thing and a bad thing. So long bonds hedge equities, but long bonds have more risk. So it's a complicated topic. You have to be sensitive to the risk inherent when you're decumulating because you just don't have that time to afford to make too many mistakes, right? So that might argue for taking some slightly different approaches, maybe moving away into those satellite pieces, low volatility. Perhaps it's something more income focused like a cover call in some sense that helps just pay the bills monthly, your monthly expenses. Those couple thoughts of how I'd look at that kind of idea of accumulating versus decumulating.
Yeah, it's a great point because I'm thinking, again, back to the RESP, saving for the kids' education. When you're decumulating that at a point in your life when you are not retired, typically, right? You're typically doing that. You're still working, but it's time to decumulate that portion of the portfolio because the kids are going to school. So yeah, that's interesting. I like your approach of thinking in terms of accumulation versus decumulation, not necessarily retirement, non-retirement, because there are these caveats for sure. And so it's a different way of thinking about it. That sounds good. Now, I noticed with BMO, you guys have ETFs for each of these different schools of thought, both things for the decumulation phase, accumulation phase. How do you suggest we decide which approach is right for us here in Canada? And feel free to speak about some of the options you have available.
Also, it's the theme of the call. I'll say the asset allocations are a great baseline tool to achieve those outcomes. We talked about ZEQT from accumulation, and then as you go down the risk, you can think of it about moving from accumulation to decumulation. So you go from 100% equity to 80-20, the Z grow, then you go to 60-40, Z Bell. I don't want to sound too pedantic, but there's 5 levels, and each of them takes off 5% or 20% of equities and moves it to fixed income. So those are great tools to start from, for sure. I said the low volatility equity ETFs. So for the equity portion, I think they can help on the decumulation side, certainly, and manage risk, but while not sacrificing too much on return, or in some cases, they actually do quite well on the return side. But certainly managing risk is the first and foremost idea there. The cover calls also take a little bit of risk off the table, but put more income. It's more of an income stream. I mentioned some of the tax efficiency around them, and they do have some benefits there where the income is more tax efficient. Which I think can be of a potential benefit as well. For sure, be careful of anything over 10 would be my baseline advice, and look at the total returns like we talked about. We've got a lot of tools. There's a lot of ways to skin the onion. On the fixed income side, there's a lot of different tools. Actually, one we just launched that, as we're talking about portfolio construction is gold. We just launched a gold ETF, and there's a lot of good research that you just put a little bit of gold. You don't typically need a lot, like we're talking 2, 3, 4%. But it's a diversifying asset. And I always say as an investor, your only free lunch is diversification. That's what I believe. And gold is a diversifying asset. It's different than equities. It's different than bonds. Tends to give you a return over time. Tends to be like a long-term return, like 5%. So it's not a huge return generator. But when markets are challenged, it can add to, when markets go risk off, as they say, gold can often play a role there. So there's another one. But yeah, lots of tools, lots of way to peel the onion, and you can obviously look at our website for more information and maybe find some of the tools and reach out to us at BMO and try and find something that works for you.
All right, Chris. So thanks for that. Can you tell us more about where we can see more of your work or where we can learn more about how to properly invest with ETFs? I know you guys have a lot of free educational resources out there. And last I checked, you guys are still the largest Canadian ETF provider. Is that still the case?
Still the case. We are the largest provider. Yeah, two great resources. Our website, BMOETFs.com. You can find information about our products, white papers. We talked about the performance comparison tool, find deep insight on our offerings, but also how it compares to other offerings in the Canadian market. So that's a great resource. And the other one you mentioned, ETFmarketinsights.com, which is also on YouTube as well, ETF Market Insights. And it's a weekly show with a variety of topics. And the idea is this is an educational resource. One week we could be talking about the S&P, we could be talking about covered calls, we could be talking about currency the next week. So it's a great variety of topics, anything and all things investing in ETFs. And so that's a great one as well to tune into.
For sure. Yeah, I'm definitely a fan of that one. And what I like about it too is listeners can still submit their questions to you guys, which is really great for somebody that's just learning this or just wants to have a little bit more detail. You can actually submit questions to be answered on there, which is fantastic. So definitely, because there's a lot of, like we talked about today, a lot of misinformation out there, a lot of traps easy to fall into. And so it's nice to have a resource where you can ask questions and get a straight answer. Because I've noticed that you guys definitely don't play these shady games that some of these other providers do. And so it's nice to have a reliable source of information that wasn't going to be skewed where there's some fine print that you didn't read or something of that nature. So thanks so much for those resources. Thanks for doing all those shows. And yeah, it's been great having you on, and thanks for educating us on all of this. And yeah, just unfortunately, so many traps that are easy to fall into. And so it's really great to have someone that's in the field who actually knows things on the back end and knows what to look for so that we as DIY Canadian investors can be careful and make sure that we don't fall into these traps ourselves. So thanks again, Chris. Great having you on. And until next time.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.